Welcome to the Deep Dive. We're Talk Tickers, your rapid response team for cutting through earnings calls. Today, we are jumping straight into MTU Aero Engines, their 9-month and Q3 2025 results call.
Yeah, this one definitely caught the market's attention.
It did. Dropped intraday, immediate positive reaction. And we heard from the new CEO, Dr. Johannes Bussmann, his first impressions, plus CFO Katia Garcia-Villa walking through what turned out to be, well, pretty spectacular numbers.
Absolutely. The big theme here, execution and really strong margin resilience. They basically showed their strategy of focusing on those high margin segments is really paying off, especially, in the aftermarket.
Okay, so let's hit the headlines right away. The big number everyone's talking about. Q3 adjusted EBIT came in at $339 million. Now remember, the consensus, what analysts expected, was around $292 million.
Right. So that's a huge beat, 16% higher than expected on core profit. That's significant.
And that profit strength flowed right through to the margins.
Exactly. The Q3 adjusted EBIT margin, it expanded 110 basis points compared to last year, hit 15.8%. Pretty impressive.
And zooming out to the full 9 months, it just reinforces that story, doesn't it? Adjusted revenue up 19%. That's solid, about 6.3 billion euros.
Good growth, yeah.
But the adjusted EBIT for those 9 months up 34%, nearly €1 billion, 995 million to be exact.
So profits growing almost twice as fast as revenue. That's it's textbook operating leverage right there.
They're squeezing more profit out of each sale, which, is exactly what investors want to see right now.
Definitely. But how they did it, that's where it gets interesting. We need to look at the segments.
Okay, let's do it. Start with OEM original equipment manufacturing, new engines, but also, crucially, spare parts. And this segment, well, it was kind of the star of the show, wasn't it?
Oh, absolutely. 9-month EBIT up a massive 44% year over year. And the margin, get this, an adjusted margin of 31.1%.
Wow. 31.1%. I mean, in aerospace manufacturing, that figure just jumps off the page. So what was it? What drove that? Was it just selling more expensive engines?
Not quite. I mean, yes, there was a favorable mix of the new engines they delivered, which helped. But the real kicker was the spare parts sales. They saw huge acceleration there.
Acceleration like how much?
Think mid to high double-digit growth just in Q3 for spares. Plus, pricing increases finally kicking in properly.
So high margin spares flying off the shelves.
Exactly. And think about what that signals, right? Huge demand, scarcity, pricing power. MTU's components are clearly critical. Now, management was careful. They said, look, 31% isn't the new normal. Expect more lower margin new engines in Q4.
Right. So it'll likely moderate?
It will moderate.
Yeah.
But it just shows the incredible leverage they have right now when that spares demand hits.
Makes sense. Okay. So OEM is benefiting hugely from spares. Let's switch gears to MRO, maintenance, repair, and overhaul. This is where they deal with the engines already flying, including the newer GTF engines.
The geared turbofan.
Reported MRO revenue grew 20% over 9 months, solid. But the adjusted EBIT margin stayed stable, 8.3%.
Right, just held steady.
Which is interesting because MRO has faced headwinds, right? Costs for new facilities like Fort Worth, the complexity of servicing these GTF engines. How did they keep that margin flat at 8.3% with all that going on?
Yeah, that's a great question. The MRO story is really about managing complexity. You got the GTF engine work ramping up fast. That share hit 40% for the 9 months.
40%, and even higher in Q3.
Spiked to 48% in Q3 alone.
Yeah.
So nearly half the MRO work is now GTF. And yeah, that brings initial costs and learning curves.
So how'd they offset that?
They focused hard on other higher value stuff. They benefited from a good mix in their independent MRO business. They also increased the work scopes on older engines, the mature wide body and narrow body fleets.
Doing more work per engine visit.
Exactly. More content, higher value, and the MLS leasing business chipped in strongly too.
MLS leasing. Remind us quickly what that is.
Sure. Material Lease Services. Basically, MTU leases out spare engine parts, or even whole engines, short term. When supply chains are tight like now and airlines desperately need a part or a loaner engine to keep flying, MLS is vital.
Got it. So that provided a steady income stream.
A nice buffer, yeah. And it all connects back to this bigger picture, this macro trend. Because the big guys, the OEMs, are slow ramping up production of new planes.
Right, the delays we keep hearing about.
Exactly. Right. So airlines have to keep their older planes flying longer, which means when those older engines finally come in for overhaul, they need more work. Bigger, more complex, higher margin shop visits.
So MTU is essentially capitalizing on the industry's production bottlenecks.
You could say that. The stress in OEM delivery helps drive profitability in MRO work scope. It's quite the dynamic.
Fascinating connection. Okay, let's talk cash, free cash flow, because the story gets even better there, despite a known headwind.
Indeed. 9-month free cash flow, FCF, hit $279 million. That's up 31% year over year. Solid improvement.
But here's the thing, that 31% jump happened, even though they paid out a hefty sum in Q3.
Right. That $100 million US dollar payment.
Related to the GTF fleet management compensation.
Yeah.
Linked to the engine availability issues.
And that payment was expected, right?
Yeah.
It's in line with their plan to pay out about $390 million US for the whole year.
Correct. So the fact that FCF still grew 31% after absorbing that $100 million hit?
That tells you a lot. It signals really strong underlying performance, better inventory management, collecting cash faster, tightening the belt elsewhere.
Real cash discipline, quality cash flow.
Exactly. That's what the market loves to see.
And given that strong performance, management felt confident enough to upgrade their full-year outlook.
Yep. Couple of key changes.
What were the big ones?
Okay, first, profitability. They tightened the adjusted EBIT growth target, now aiming for mid-20s% growth, basically signaling they expect to hit the upper end of their previous range.
So more confidence in maintaining margin momentum.
Correct. Second, and this is probably the bigger one for valuation folks, they raised the free cash flow guidance significantly. The new range is $350 million to $400 million. That's up from $300 million to $350 million before.
That's a substantial jump, a clear signal of better cash conversion than they initially expected.
Absolutely. And what's important to remember, like you said, this is all margin driven.
Yeah, the revenue guidance stayed the same, 8.6 to 8.8 billion.
Right. And they kept that revenue guidance even while assuming a weaker exchange rate, 1.13 USD per euro.
So they basically absorbed an FX headwind on the top line forecast and still raised the profit and cash flow outlook.
Shows the underlying strength is real. It's not just currency effects helping them.
And that strength showed up in operational updates too, right? Like on the GTF program.
Yeah, big news there. The GTF Advantage engine, the next iteration, got its ESA certification. That's the European regulator. Means final assembly and first deliveries are still on track for mid-2026. Keeps a key part of the future OEM plan locked in.
Good progress. What about those macro issues? Tariffs and defense.
Okay, tariffs. That's been a headache for lots of industrials. MTU seems to have handled it really well. They lowered the expected hit for 2025 down to just a low double-digit million euro figure.
That's down from what, mid to high double digits before?
Exactly. Pretty significant reduction. And they said it was purely down to changing logistics, tweaking contracts, smart tactical management.
Nice. And on the defense side, smaller business, but strategically important.
Yeah, defense is all about long-term visibility. Germany confirmed it's buying 20 more Eurofighter jets. For MTU, that means 52 engines, deliveries slotted for 2031 to 2034, locks in revenue way out.
Okay, steady work there. What about the really big future program, FCAS?
Future Combat Air System. Yeah, they sounded very confident. Crucially, they explicitly said FCAS is included in their 2030 guidance.
Included already, even before all the final political agreements.
Seems so. They're waiting on political clarification by year-end, but baking it into their long-term plans sends a strong signal. They clearly believe it's happening and they're planning for the R&D and production work.
That is a bold statement of confidence in that massive European program. Okay, we have to touch on the one number that, on the surface, looked less rosy. The backlog.
Yes, the backlog contracted a bit, down to $24.1 billion from $28.7 billion at the end of last year.
So orders went down. How did the market take that?
Well, this is where you see the market focus. The drop was mostly due to FX, the stronger euro, making the dollar-denominated orders worth less in euro terms. And the market basically shrugged it off.
Really? Ignored a backlog drop.
Pretty much. They focus squarely on the things that matter now. The profitability beat, the higher margins, and especially that raised free cash flow guidance. It seems investors are rewarding actual cash generation and margin resilience more than just the size of the order book right now, especially if the dip is just FX.
Interesting. Execution over orders, at least for now. Okay, this brings us perfectly to our next segment. Let's shift gears to This Is Not Financial Advice, where we explore an outrageous, maybe, but plausible trade idea based purely on what we've just heard.
All right, so the thesis here builds directly on that execution story. MTU is showing it can deliver strong margins and, importantly, convert that into cash, even with headwinds.
While some competitors are struggling more.
Exactly. You look across the aerospace supply chain, many OEMs are battling severe bottlenecks. Demand is there, but they can't deliver, or it's costing them a fortune hitting their own cash flow.
Right. Trapped capital, negative FCF in some cases.
Precisely. So the outrageous but plausible idea, a pair trade.
Okay. Long one, short another.
You go long MTU Aero Engines, you like their execution, their aftermarket strength, that raised FCF guidance providing a floor, and you fund that long position by going short one of their peers. Well, that's the homework. You'd look for an OEM peer that seems more tangled up in supply chain issues, maybe showing weaker cash conversion, less able to capitalize on this strong aftermarket demand.
So you're betting on the performance gap widening.
You're betting on the spread, yeah. The bet is that MTU's superior execution, its cash generation, its ability to manage things like tariffs, that justifies a growing valuation premium compared to competitors who are maybe fumbling the ball a bit more in this environment.
Even acknowledging that 31% OEM margin won't last forever.
Right. That margin will come down.
Yeah.
But the underlying strength in spares and the clear improvement in FCF provides the momentum and cushion for the trade thesis. It's a bet on operational resilience and cash quality winning out.
A fascinating play, definitely focusing on that execution divergence. Okay, let's wrap this deep dive up. Quick summary for everyone. 3 key takeaways from MTU's Q3 and 9-month results. First,
Definitely the profitability beat, driven by that surge in high-margin spare parts and a good mix in OEM, leading to that standout 31% margin in Q3.
second takeaway.
Cash is king. Free cash flow guidance raised substantially now, $350 to $400 million, shows real confidence in cash discipline, even with those GTF payments.
And third,
Solid operational progress. GTF Advantage certified, keeping future plans on track. Plus, they effectively managed those tariff headwinds and showed long-term confidence by baking FCAS into the 2030 plan. Smart execution across the board.
great summary. Okay, final provocative thought for you, our listener, to chew on.
Here it is. We saw how MTU's MRO segment is benefiting right now because slow new engine deliveries are forcing airlines to spend more, keeping older engines flying longer, right? Wider work scopes, more content. So the question is, how much further can MTU push that? How much more content and value can they extract from these mature engine overhauls before the big OEMs finally sort out their production lines and the whole aftermarket dynamic starts to, well, normalize again?
Ooh, good one. When does the tailwind from industry problems start to fade? That tension between MRO gains and eventual OEM recovery.
That's the key thing to watch heading into 2026, I think.
Excellent point to end on. Thank you for joining us for this deep dive into MTU Aero Engines. Remember, all this insight comes directly from their public earnings materials. Until next time, we'll keep digging.